This episode of Talk Your Book was proudly brought to you by DXN for Edge Data Center Solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Andrew Mitchell, thanks for coming on Talk Your Book. Really appreciate your time. Why don't you start with Ophir Asset Management and what you guys look to invest in?
Yeah, so Ophir was established in 2012. We are a small cap, mid cap fund manager. We invest in Australian stocks and global companies. We have 3 funds, and we're really looking for companies that the market's missing, that are accelerating growth or taking market share in big markets. And we're looking for an edge, something that the market hasn't worked out, that we're able to work out and see some big value realisation, which comes through, of course, through share prices going up.
And what stock do you want to talk about today?
Well, I thought I'd talk about a nice little small one that we think's got potential to be a big company called Chic.
And what's their background? What do they do?
Well, Chic has been around for a while. It's in plus size women's clothing in Australia and New Zealand. But the key differentiator for this business is it's a true omni retailer. The value that's being brought to investors is coming through the online channel. So omni retailer means you've got bricks and mortar stores, but you've also got a strong online presence. And that's where the real value is for Chic.
And what's their current strategy?
So the strategy is you've got retail format, and that's in Australia. They've got 110 stores. They're rolling out stores. We see them going to 150. They've got an online presence. That's really where the growth is coming from. They acquire customers generally via the store or online, but the way the store works is you get your customers there and then people start transacting online and become repeat customers, and they're the customers you want, the ones that keep coming back and just buying your product religiously.
So we might dig into those units one at a time. In terms of store rollout, some people see a store rollout and they think really nice, predictable cash flows that we can predict. Others see it and think CapEx going up and a fixed cost base increase. How do you view that sort of store rollout in Australia?
Well, we look on a return on capital. So if you spend $1 to fit out a store and put the inventory in the store, how much profit, how much cash do you get back in a year? And so for Chic, they're getting a 30% return on the capital. Now, this is coming through not only through the stores, because of course they've got the online that's getting driven or pulled through by their stores. So we see it as a real neat way of growing their business and driving their online sales. Key differentiator for Chic is that their expense in terms of marketing is less than 1% of sales. That is tiny for a retailer. And that's because they're really able to leverage off these clever ways of bringing customers in and then keeping the customers.
And a pretty good social media presence too.
Yes,
a lot of these listed companies perhaps a little bit slow to the party with social media and their presence there. They look like a company that gets the joke in that sense. Yeah,
it is. They don't spend much money on social media, but it's able to grow. And one thing you learn very quickly when you speak to the Chic people, especially Phil Ryan, who's the founder, CEO, who runs the business, the passion that he has for the customer and his customer or Chic's customer, I haven't experienced it with any other company CEO. And I think when you have that sort of passion for your underlying customer, that brings a lot of loyalty, and he is able to get that customer and then keep them and transacting many times over. I should also say about their strategy, one thing I didn't say was they've been growing through category expansion. So you start off with women's fashion dresses. Then you're selling, they've got a teen brand now, so they're selling to teens, but they're also selling boots, lingerie, different categories, if you like, and so they're getting a greater share of the wallet of their customers. So you get a loyal customer, then you give them more products that they like, they buy them, they tell their friends, and that whole ecosystem really works.
The only category that looks like it's missing is the mature female market. Is that something you could see them expanding into?
Oh, 100%. Good question. They've just made an acquisition of Avenue, which is a US, very well-known plus size branded company that owned, I think, 300 stores at one stage. Doesn't own any stores now. They own the online business. But Avenue is that 40-year-old plus brand in the US, and there's a real opportunity to continue to roll that out in the US alongside City Chic, but also bring the Avenue brand to Australia and maybe even Europe as well. So then, yeah, they can certainly hit that category.
And so it sounds like you're a fan of the Avenue acquisition. What did you like about it, and do you think the market valued that appropriately?
Avenue acquisition, it cost 15, 16, 17 million, something around that US to purchase the business. Now, it's an online business. It came with 70 staff and it was doing $70 million of US sales when they bought it. Now, this company has been round and round through private equity. I've spoken to a former CEO of this business of 10 years ago who consults very heavily into the plus size industry, and he gave me a lot of insights to it. In the last ownership, it's really sort of lost its way. That 40-year-old plus category, they tend to spend less on fashion as they get older, and it hasn't. The category that they did very well in is as they've got older, they're spending less, but they haven't been adding younger people down the bottom of the funnel.
Yeah.
At the same time, they've been forced to discount, run really low inventory, and they've had a cumbersome logistics network as well. So it's gone out of business. But with $70 million of sales that we think they can get around 50% gross profit margin, they have 70 people they've acquired. We've done a lot of work in terms of how many people that under the City Chic banner are needed to actually run the Avenue brand. And we think it's probably somewhere between 10 to 20.
Wow.
We can see in an upside scenario that this business in a year or 2 years' time could make $15 to $20 million EBITDA. Putting this into context, they bought it for $15 million, and this will add huge amount to the 50% or so to the profit of City Chic.
And so City Chic's PE is relatively pricey, sort of in the mid-20s range. Would you like to see them use that to continue to make earnings accretive acquisitions, or would you like them to settle with what they've got and really build for organic growth from here?
Well, I think the key point I'd make is when you're looking at that mid-PE, that the business is growing at 20%. So in a year's time, it's actually lower. But also that doesn't have that acquisition that I spoke about. So I can see this actually trading on something like 15 times PE 1 year forward, which is below a market multiple, and for a business that's growing at 20% and taking market share in a growing industry in the United States, which is obviously a huge market. So I don't think it's expensive at all if they can deliver that Avenue acquisition. Where it is now at that multiple, I think simply reflects where it is the City Chic business at 25 times. Now, to address your question in terms of should they make more accretive acquisitions, of course, like that's a slam dunk acquisition. If it comes along again, please make it. But they do have a lot on their plate. Yeah. So don't try and force the acquisition. If the right one comes along, make it. But don't force one and pay too much for something and take on too much risk.
You hear some investors, and it can be a bit simple and it's different for different industries, but they'll talk whatever the PE is, if the percentage of growth is the same as the PE, that's something they can get comfortable with.
PEG ratio.
Is that sort of something that you rely around for a lot of business? If their PE is 30 but they're growing by 30%, you can often get comfortable with that sort of valuation?
It's a rule of thumb. Obviously, without getting too technical, interest rates are really low at the moment. So you're probably, when a company's growing at the same rate as its price to earnings ratio, that's 1 time. So it's trading at 1 times PEG ratio. 5 years ago, that was common, less so common now because interest rates are really low. People don't want to put their money in the bank. They get better more from dividends and the likes in equities. So you're seeing that you're having to pay a bit more in terms of your price to earnings ratio to that growth. So we're sort of seeing 1 to 1.5 times to be more regular. But yes, that's a rule of thumb that you can use. And if you're getting 1 times, you're doing pretty well.
And they're going to have operations now in the Northern Hemisphere and the Southern Hemisphere.
Yep.
What are some of the watch-outs there or things that may cause for concern, and what sort of opportunities does that open up as well?
In terms of, I guess, retail sales, they're very choppy. in Australia at the moment. Now, these guys are taking market share as they're growing, but the key thing we're focused on is the overall growth of online and the retail stores. There is a risk. We think the retail same-store sales for their actual retail format could go negative. That's not a cause for alarm, but we don't know how the market will react to that, because if the online sales are still growing at 30% or 25 to 30% and your retail stores are doing -2%, you should put the Australian business together. So we're focused on that. We think it's got enough momentum, but obviously if sales really slow because of a weak economic backdrop, that's something to watch. The currency, because you're purchasing in US dollars, the Aussie dollar is weak, so that could put some pressure on the gross profit margin. And again, the US, that we're seeing a real acceleration in the growth. In the second half of last year, you saw the growth, I think it was 70-80% in the US online. It's certainly got momentum, but it's a lot harder market than Australia, a lot more competitive, and that means things can go wrong. Competitors can start eating your lunch rather than you eating their lunch, which is what's happening at the moment.
And no bricks and mortar stores in the US for City Chic?
No.
So how does the model work for their US sales?
So it's a really clever model, and I can't stress enough that we really rate Phil Ryan, the CEO, and this was not born overnight. There were a lot of mistakes made refining their process in the US. They did have stores, they've closed them down, and they've got a really clever way, we think, of acquiring customers. As I said before, their marketing to sales is virtually zero in the US. So acquiring customers and how much you're willing to pay to get someone to buy a garment from you and become a customer is a key metric. The way they have done it is they have a wholesale relationship where they're selling into the department stores. I think the Macy's and those sort of, our Myer and David Jones. Now, when someone goes and purchases with one of these stores, they get a City Chic garment with the City Chic tags on the back, and that's how they've been driving their online, because if people like the garment, they then go and Google City Chic, and then they purchase online. So that's getting them a lot of margin by not spending on marketing and acquiring those customers very, very intelligently.
And so a lot of the VC investors love talking about lifetime value of a customer divided by the customer acquisition costs. Have you ran those sort of numbers on the City Chic customer?
So the City Chic customer is super valuable for exactly what you said. They come back and they keep transacting. And as I was saying before, you're giving them more categories that you keep selling them, you keep selling them, you keep selling them. We don't have the data to work out the churn of the active customer base, but the number will be really high.
And what are some of the risks? What are some of the things you'll be watching out for to see if they change, where you might have to change your view on the stock?
So we're always looking for a strategy change, a strategy that comes out of left field. When companies start pivoting the way they do things, it can be a real warning sign. What we've seen to date is them executing on an existing strategy. But if they come out with something from left field, that will certainly put us on watch. So we look for those sort of things. We're looking for the top line, so revenue. That's a key driver for a growth company. They're taking market share. If they stop taking market share, that's obviously very negative. But if that top line starts to slow, at the moment it's accelerating in the US. If that turns from an acceleration to a deceleration, still growing, but not at the same increasing rate, that's something to watch. It just means it shouldn't get as premium rating. But when you're growing in a market as big as the US and you've got that sort of accelerating sales line, which they have at the moment, the sky is really the limit. So we just want to see them continue to execute on that trajectory.
Beautiful. Sounds like a great story. Really appreciate you coming on.
Right, thanks very much,
Thanks for your
Chris.
time. Thanks, Andrew.
Really appreciate you having me. Thank you.
Cheers. This episode of Talk Your Book was proudly brought to you by DXN for Edge Data Center Solutions.